You were 22 once. Maybe you're not that far from it now. Maybe it feels like yesterday. At 22, you probably weren't thinking about index funds. You were thinking about rent, about finally having your own money, about what to do with the first real paycheck you'd ever earned. Maybe you were thinking about a car, or a trip, or just making it to the end of the month without going into the red. $100 felt like a lot. Or at least like something that could be useful somewhere else. Here is the number that changes how you see every dollar you've ever had. If you had taken $100, not every 100 you ever made, just $100 each month, and invested it in a broad market index fund from the day you turned 22, by the time you reached 65 you would have approximately $850,000. Not because you were lucky. Not because you picked the right company at the right moment. Because of how time and compound interest actually work, and because the math is almost entirely indifferent to your income level. Compound interest is the process by which your returns generate their own returns, which generate their own returns, until the growth curve stops looking like a straight line and starts bending almost vertically upward. It is not a financial product. It is not something exclusive or complicated. It is a mathematical property of money left alone long enough. In the first decade, the curve barely moves. At 32, your $100 a month portfolio would be worth roughly $20,000. It doesn't feel like anything is happening. It doesn't feel like it's working. And that is the part that trips almost everyone up, because compound interest does the majority of its work in the final third of the timeline, not the first. The last 10 years of a 43-year window can produce more than the entire previous 33 years combined. The $850,000 figure is based on the historical average annual return of the S&P 500, the index of the 500 largest publicly traded companies in the United States. Over the last 30 years, the return has averaged roughly 10% per year. Not every year, some years the market dropped 30%, or 40%, or more. Some years it gained 20%, or 25%. But annualized across decades, the number is approximately 10%. That 10% is not a forecast. It is a historical record. Now run the same scenario, but you wait. Not long. Just 10 years. You start at 32 instead of 22. Same $100 a month. Same fund. Same historical return. By the time you reach 65, you end up with roughly $300,000. The difference between starting at 22 and starting at 32 is more than $500,000. You invested only $12,000 more by starting earlier, 10 additional years, times $1,200 a year. But you got more than $550,000 more in return. That $12,000 gap in contributions produced a $500,000 gap in outcomes. Not through timing the market. Not through any skill or insight. Just by being earlier. This is the math that almost nobody intuitively grasps, because humans are not wired to think exponentially. We understand addition. We understand saving $10 and having $10 more. We do not naturally understand doubling, compounding, the way a small quantity multiplied by itself enough times becomes something almost unrecognizable. Warren Buffett's story is the clearest real-world illustration of this that exists. He began investing at age 11, in real stocks, with his own money. He is by most measures the greatest investor in recorded history. But there is one fact about Buffett that almost never gets discussed alongside his legendary stock-picking ability. Approximately 99% of his net worth was accumulated after his 50th birthday. Not because he suddenly became a better investor in his 50s. Because he had been letting money compound since childhood, and by the time the exponential curve entered its steep phase, the base it was working on was enormous. The final number looks like genius. It is actually arithmetic applied over a very long runway. The curve doesn't reveal itself until near the end. That is the counterintuitive part. And that is what makes most people at 22 believe it doesn't matter yet. Let's look at where the $850,000 actually comes from. Over 43 years, your total contributions are $51,600, that's $1,200 a year, times 43 years. The other $798,000 came from returns compounding on returns. Your money made money. That money made more money. The compounding did more than 93% of the work. Your contributions did less than 7%. Your $51,600 did not build $850,000. Time built $850,000. Your $51,600 just showed up. And yet the thing most people do at 22 is wait. Not because they're irresponsible. Not because they've never heard the words compound interest before. But because $100 a month at 22 doesn't feel like the kind of decision that leads to $850,000. It feels like a rounding error. It feels like the kind of strategy that matters for people who already have money, not for someone whose budget is already stretched, who has student loans, who is just trying to feel stable before taking on anything new. This is exactly what the Dalbar QAIB annual report documents every year. Since 1994, Dalbar has tracked the difference between what the market returns and what the average equity investor actually captures. In nearly every measured period, the average investor has underperformed the S&P 500, sometimes by 3 or 4 percentage points per year. The gap isn't explained by bad stock picks. It's explained by behavior. By waiting for the right moment. By hesitating when the market drops. By pausing until things feel clearer. And eventually starting a decade late. The difference between the market's return and the investor's return is not knowledge. It's time and the decisions about when to let time start working. Now suppose you're 32 right now. Or 35. And you feel like you've already missed the window. You haven't. The compounding math changes the final number, not the principle. Starting at 32 with $100 a month still produces approximately $300,000 by 65. Increasing that contribution to $200 a month brings it to roughly $600,000. The mechanism still works. The curve still bends. You just don't get the head start. But here is the piece that gets missed in almost every version of this conversation. The $100 a month was never really the point. The $100 is a stand-in for a habit, the decision to invest consistently, automatically, regardless of what the market is doing in any given month, what the headlines say, or how uncertain things feel right now. The number that matters isn't the contribution amount. It's the start date. Jack Bogle, who founded Vanguard and created the first index fund available to ordinary investors in 1976, spent his entire career making a single argument, that most people would be better served by owning the entire market cheaply and automatically, for as long as possible, than by trying to pick, time, or outperform it. Not because passive investing is exciting. Because it captures the full return the market offers, and it removes the behavioral drag of constantly deciding whether today is the right moment to act. There is a finding, widely reported and often misattributed, that Fidelity's best-performing accounts over long periods were the accounts of people who were deceased, or who had simply forgotten they had an account at all. Not because inaction requires any particular skill. Because inaction, inside a broadly diversified fund, means the compounding continues uninterrupted by the very human impulse to react, to move, to do something. The number that destroyed more retirement security over the last 30 years than any market crash, any bad stock, any failed investment is simpler than any of those. It is the decision to wait until things feel more certain. Until you have more money. Until the market settles. Until next year seems less complicated than this one. Certainty never arrives. Next year becomes the year after. The chart you were waiting to stabilize keeps moving without you. At 22, you had something worth more than any salary, more than any strategy, more than any financial advice you've ever been given. You had 43 years. You might still have 33. Or 23. Or more, if you're reading this early enough. The mechanism doesn't change. The curve still bends. The compounding still works. The market, historically, moves upward over long enough time periods. The only variable entirely within your control is when you start. $100 a month. Not a windfall. Not a perfect plan. Not a hot stock. $100 invested in a low-cost index fund, left alone, automatically, for as long as you can manage. That's the scenario. That's the number. That's $850,000. You were 22 once. The version of you who started then is sitting on a number that would change everything. The version of you who starts today is still building a number. It's just the number you actually get to have.